let's go back to this amazing position that we have that Troy sent to me earlier today. Troy is in RIOT, and he has been in RIOT for a few months. Bought RIOT months ago at 637 and been rolling ever since, he says. Excellent. The last roll when RIOT was near 80, I sold the March 80 call at 22.38 and long March 50 put at 11.32. Here's again is a standard collar, but what I'd call a no-cost collar as well. Stock ramped up. Now it pulled back to 43. He shows unrealized gains of 3,700 on the stock, 1,984 on the call, and 192 on the put. It's not all profit. There were debit rolls, but he estimates it's up 2K on the way up. Would you suggest that I buy to close this call at 195? It changed a little bit since Troy sent the email. It's currently trading at 232. But let's take a look at some of the things. And again, we're just going to do this manually on the profit and loss chart. So we got to jot down these numbers. At least I do. You're watching live, so you don't have to. But in any case, he's got a guaranteed profit of about 5,500 on the position. I know his stock price is probably different with the rolls he mentioned. We put it in at 637 with the 22.38 call sold here. So he might be up at $8, maybe a little bit more, maybe a little bit less. He does mention he has a profit on this trade. Net credit of 470 for the position. He's paid for the stock completely. Guaranteed profit to the downside, $5,500, because he has the 50 strike put and a net credit of 469. And the max profit, of course, if it was at 80, is 84.69, and we're probably looking more at this 54.69 position right now. So 54.69 to the downside, guaranteed, and 84.69 not probably going to realize unless RIOT jumps back up to 80 in the next 20 days. So the discussion here is, what are some of the things that we can do? Well, we could buy back this call and realize $20 realized gain against the position, which would put this at a even more negative cost basis naturally. Let's just take a look at that. We'll simulate buying the call back. So we just go into the options field. Got to scroll down to the 80 call. We're going to buy it back at 223. Okay? Or the midpoint. That leaves us with just a March married put where we still have a profit of 52.37. Why is it lower? Well, we didn't realize that extra 232 we had to buy back. We still have infinite upside. We're holding the 50 put. So let's get some more premium. We'll keep it in March to keep the standard collar format. I don't want to go below the 50 put, though, and create a bearish position necessarily. If I did that, if I sold the 45 call, it'd look like a bear call credit spread. We have a question coming up on one of those in a moment. So I'm going to go with a 60. It's about 470, 475. Get a new $400 in this case. What does that do to the position? It increases the guaranteed profit to the downside from 54.69 to 57.12. We lower the maximum upside return because we're only getting 60 back now in the best case scenario, not 80. So it lowers from 8,469 maximum profit to 6,712. But you've also increased this credit that you have on this entire position. Remember, originally it was a 469 credit, and again, I know Troy's numbers are different, but in this case, it'd be 712. And so this does get you more here, gets you more to the downside profit if it stays below 50, doesn't have as increased maximum profit because we're not at 80 anymore, we're at 60. That would be the effect of adjusting this collar in this fashion. Troy had also mentioned, so what this did is it simulated buying back this call and then selling the new call and giving us the new numbers, 712, 5712, and 6712, yeah. Okay, now, can I move the put up? Well, if I move the put up, it's going to be at a debit in this case, but it's going to lock in potentially more profit. We could create what's called a conversion. Straight line profit and loss chart. How would we do that? Well, since we've already rolled up to the 60 call, let's sell the 50 put and buy the 60. Are these Now, these are a little bit beyond intrinsic right now, so not going to work as well as I wanted, but let's simulate selling the close the 50 and buying the 60. This gives us a straight line profit and loss chart known as a conversion. Did I pick the wrong date? Oh, there it is. Yeah, I'm sorry, folks. But it puts you to guaranteed profit of 59.40. If the stock's above 50, what happens? You get assigned on the call and the put I'm 60, I'm sorry. You get assigned on the call, the put expires worthless. If the stock stays below 60, you close the stock for 60 and the call expires worthless. So either way, you're making $59.40, which is another $200 over the 57.12 we saw just rolling the call. What it did do, though, is take you out of that credit for the position because the debit to roll costs a little bit more than $700. So now I actually am back in a debit on the entire spread instead of where you're seeing a credit before because you paid for all of the stock with the rolls also. So rolling the put up in this case kind of increases your return. If you're expecting the stock to stay below 50 anyway, you can get an extra couple $100 here by rolling the put up and rolling down the call. Would put you at $59.40 compared to where we started with a guaranteed profit of $54.69 in the next 22 days. If you expect that RIOT could have more upside, it could shoot back up to 60, 65, or 70, might want to leave the 80 call open and not roll it down. Or roll down to the 60 and not move the put and just take that profit that we were seeing of 67.12, leaving some upside instead of the locked in straight line conversion position that we're seeing here. Okay, Troy, so those are some of my thoughts there on what we're looking at with the position. You can also run other scenarios later as well for that awesome RIOT position. Stock at 637, now at 44, but when it hit 80, you sold the 80 call for $22 and you bought the 50 put for 11. No cost on the stock position right now. Net credit to own the stock and still have a position where you're at 5,400 profit if the stock stays below 50 right now. Could get more if the stock recovers and moves up. All right. Now, let's talk to Jerry for a moment. And then we got Roger, and then we got Mark. Oh, Mark, I'll get to that at the end of the presentation. Just give me a couple moments. So, Jerry says, Mike, I'm presently holding 3 long calls that were on a bullish uptrend, but the last 2 weeks they have dropped 70%. What can be done if I'm still bullish on these March 19th long calls? Any great education web positions from power options? How far out to roll or adjust? Okay, so first, if we go to the free webinar section and the option strategy section, we're going to scroll down pretty far here on this list. And here's one that's similar, rolling out a long put that is now out of the money. So your long calls are now out of the money likely with a 70% loss because the market turns. So there's one, but it's related to puts, not necessarily yours. What I'm looking for is, let me scroll down further here. Didn't think it was that old. It is. Here it is. Managing your long options positions. Management techniques for long calls and puts when the underlying security moves against you. Managing position if it's profitable, but the first point, managing those as well. It is older. There are some more recent ones, Jerry. I'll have to scroll through YouTube and point you to those. But for now, let's say that several days ago, just use one of mine if you don't mind, Jerry. Not mine exactly. It's a married put, but it's waffled a bit. Let's say a while ago, beginning of the month for March expiration, when the stock was trading around $68, $70 per share, $71 per share, I bought a DAR March 70 call. And we're at 60, where are we now? 63.04. So I'm actually going to put it at about $4, 75% loss, a little bit more, a little bit less. Let's put it at about $4.20, $4.25. I don't know if that's accurate, but I know the stock was up near 71. And looking at the prices that they're here between the 60 and the 63, I think a price of $4.25 is fairly logical. All right. And of course, we saw that the liquidation value now is $1.40. Right? Okay, $1.50, excuse me. All right, so we're near that 75% loss, Jerry, on this position. If you have no events coming up, and this is key for your stocks too, DAR still has earnings coming up within the next 10 days. Yeah. 6 days, 4 days, excuse me, 3/2, Tuesday. So DAR has earnings coming up on March 2nd. In this case, I might be tempted, I know you hate to hear it, but in this case, I might be tempted to leave this position alone. Because if it does have a good earnings and it jumps back up to 70 or 71, I might be able to get at least half of the loss I have back, maybe a little bit more. But you and I both know, Jerry, in that case, what's going to happen? Any implied volatility I have in this call after the earnings on 3/2 is going to deteriorate out. So I'm just going to be a little bit over intrinsic value, not as inflated once the implied volatility collapses on this position. What I would consider doing is rolling down this call, maybe even converting it to a spread. But what we know is going to happen with those two things, I'm going to get a lower break-even price to get to profit, but I'm going to increase the cost of the position. And I would want to give myself, as we talked about, we saw with the married put and the time decay, Jerry, that we saw on that time decay curve in the last 60 to 30 days, I'd be looking at least 90 days out in time. That's going to be an even higher debit, but that's what I was consider. So what am I going to do? I'm going to get back what I can from March, $1.50. So right away, we know that we're going to be, I can only go to July. Bummer. I was hoping to stay closer to 90 days, but we'll have to stick with July with the DAR example. And I'm probably going in the money, honestly. Because why? Once again, the at-the-money bell curve. The 60 call and the 65 have the highest time value. Right? The stock's at 63. So my 65 is right here. The 60 is right here. So I probably want to be doing maybe even the 55 in this case. Yes, it's a higher price, but 8 of it is intrinsic, so only about 7. Wow, it's still almost even. That could be related to the earnings. But okay, that's why to consider going in the money, Jerry, in this case. So let's see what it would look like, and I'm not going to like these numbers. Oh, no, 55. I'm sorry, 55. Let me clear the 50 out. So we're going to sell to close the March 70, buy the July 55. I took my risk from 425 up to 1585. I have a break even now of 67.47 instead of 74.25. I have more time now in the position. At least went 90 days out, Jerry. That's my usual plan to go in that structure. And we've got earnings coming up between now and this expiration. Well, it's coming up in March in 2 days. So if it falls, what could happen? I could lose half of this, which means I'm almost losing double of what the original risk was at 425. That's the consideration. You did mention that you were still bullish on these positions. So that's another reason why you want to go at least 90 days out in time, I feel, even though the cost is high. What I may tend to do in these situations, Jerry, is once I've decided that I'm going to go this route and adjust the long call down in price to try to get a better break even with events coming up or not. In DAR situation, I'd wait after March 2nd to do anything else. But if I didn't have earnings coming up on March 2nd, what I'd probably consider doing now, after I've made this roll down, is maybe selling this call again. Now, I wouldn't do the 65 because it's too close, but I may sell this call that I had recently owned to create a calendar spread. Gives me a better break even of 65.55. If it starts to shoot up to go above 70, I'd look to roll it, treat it just as some people say the poor man's covered call. You're treating it as a covered call now to help repair the loss in the position. I'm still risking 1,400, 3 times more than what I originally started out with. That's what management does. You get a better break even. In this case, you give yourself more time, but you're going to be facing a higher risk, and I'm going to start trying to manage that potentially by doing calendar spreads against these positions as well. Okay, that's what I'm going to look to do in these scenarios. A lot of investors will say, well, just convert it to a butterfly. How would you do that? Okay, so DAR is down now. I would not do this. What I'm going to show you is something I don't do. I'm going to be upfront with that. I don't try to convert these to a butterfly, but it is a way to do it. And how would I convert this to a butterfly? Well, a butterfly position is selling twice as many calls normally at the money and buying two outside wings. Well, you already have the outside wing, your long call strike. The at the money, I guess we're going to have to go with 65 because I don't want to go in the money. And then we'll buy maybe a further out wing. Okay. I wouldn't recommend this with an iron butterfly where you're doing two credit spreads, selling a 63 call and a 63 put, and then buying a lower strike put in that case. But an all call butterfly, keep the same expiration. Sell two 65s. I'm going to buy a 60. I'm just going to keep it even. Okay. So we get $6 back, which cuts into the cost basis, but we take pretty much all of that to pay for this other call that's here. That now gives you a window. You're almost essentially at break even. You're closer to break even right now on this downside. You're still at a loss, though. This situation didn't repair the entire position. You're still at a loss. You kept the shorter term position rather than rolling further out. Why did I not mention this to you? Because you mentioned to me that you're still bullish. Is this a bullish structure? No, this is a repair. This converted your long calls into a neutral position, but kept only the 22 days out in time. This is not a repair if I was in that DAR call. Why? Because earnings is coming up in 2 days. Now, if it goes down, hey, I hedged some of the loss, but if it shoots up, I'm not where I want to be. In fact, if it goes back up to where it was, 70 or 71, we might be near a profit, or at least closer to a break even, here at a maximum loss of 370. Slightly less than the original 425 I paid for this call. But again, because you said you were bullish, and that's your expectation, I would consider keeping the same sentiment of the long call for the bullish position. Give yourself a roll to at least 90 days, maybe more. And then if you don't have any near-term events coming up, look to sell one of those out-of-the-money calls to start hedging the cost basis of the new adjusted long call you rolled out to, which of course is increasing your risk. I'm not saying this is the best way. I'm not saying this is the only way to repair a position with what we first showed with rolling the DAR position down. Oh, sorry, DAR position down. That's what I typically look to do to keep it simple. And because you're still bullish, I don't want to convert it to a bearish credit spread right now by selling a lower strike call, or convert it to some kind of ratio spread that has one of those death valleys in the middle. The butterfly is a potential repair, but that's only if you think the stock is going to stagnate. You're still bullish longer term. So that's why I think the first alternative is better for you, Jerry. My opinion.